Hi, welcome to Market in a Minute. So last week we talked about this being an AI economy and an AI market. Everything's being dominated by the build out of AI. What we wanted to do is look at those Mag 7. Actually, we think there's 8. But look at the Mag 7 stocks, do some more analysis of them, get a kind of a forward-looking view of everything, and maybe there's other ways of playing this that have more upside. So we're going to provide maybe a better idea as well. So the Magnificent Seven analysis. In the last quarter, the second quarter GDP growth. Catch this. So we saw roughly 3% GDP growth. Of the 3%, 1.3% was related to the AI build out. So that's roughly 43% of the growth came from AI. That's a kind of a head scratcher, isn't it? Never seen anything like that. And in reviewing these stocks, so the Mag 7 stocks, we think there's actually 8. So you don't count Alphabet twice, but count it once. That's a nice big position. It's ahead of Amazon if you do that. So it's a number 4 company. There's eight different positions because Broadcom snuck in there. Broadcom has been very strong. It's on the coattails of Nvidia. So there's 8 different stocks, and Tesla's kind of struggling. So if you look at those 8, what does it look like, right? So it's roughly those 8 stocks are roughly 37% of the S&P 500, 37%. It's kind of interesting, 37% of the S&P and 43% of the GDP growth. That kind of makes sense. So as the growth of the AI build out starts to decelerate, so it's less of a weighting of the GDP, likely these companies will start to slow down in terms of their weightings in the S&P 500. Other companies will probably start to grow faster in some manner, especially as interest rates come down as we go through the latter part of this year and into next year. Now, one of the biggest problems that has been a while now, but one of the biggest problems on the earnings reports has been that the power needs. That's what's constraining the growth of the data centers. So that will slowly get resolved, and the data center growth will slowly start to roll over or slow down as we go into 2026, later part of 2026 and into 2027 is our best guess at this point. So during the tech bubble of the 1990s, and I remember it well, it was a lot of fun. Cisco was the biggest company in the world. It was ahead of, guess who? Microsoft. So what do we have now? We have Nvidia being the biggest company and Microsoft being the second biggest. So what happens is that the capital spending side of this build out will slow down. Same thing that happened during the dot-com phase. Cisco was a winner, Nvidia was a winner then or now, and we're going to see probably Nvidia hitting a brick wall at some point in time. I know that's not something that people want to hear if they own a big position in it, and it's 8% of the S&P 500 as well. So just so you know, Cisco has not hit a new high now after 25 years. The fundamentals of the top 8. Okay, so look at this group. The earnings reports were beautiful. Okay, so the group trades at 32 times earnings, and we took out Tesla, but 32 times earnings. That seems about right. For 31% earnings growth in the quarter, that seems very reasonable. So what's the sustainability of that? And then the revenue growth was 24%. So they're seeing some nice margin expansion as well. If you look out to next year, we're seeing estimates now of 12.5% earnings growth. We don't think that's right, but maybe those are just conservative numbers. We think it's probably going to be more like 20 or 22 times earnings growth. That would be what the market would anticipate if it had a 32 multiple on it. So looking at the S&P, what's going on in the S&P? So this group's growing at 31%. If you look at the S&P 500, it's growing at 10. Now next year is going to grow at 13%. That's the estimates currently. 13% for the S&P. You're not going to see, like I mentioned, 12 and a half. You're going to see probably 20 or 20 plus out of this group in terms of earnings growth. So there's going to be some market share shifts in terms of those top stocks in the S&P 500. Maybe they don't come down a lot in price. Maybe they start to slow down in their advance, and other companies start to gain some of that weighting in the S&P 500. That's what we're anticipating to occur as we go into next year. So looking at the group, what's interesting? Well, you look at the multiples of, say, NVIDIA, it's close to 40 times PE multiple over the next 12 months. That's not the previous 12, but over the next 12 months. That factors quite a bit of growth there. And then you look at the enterprise value to trailing 12 months revenue, it's 30 times. That's really high. And so they had a good quarter, up 33% in terms of earnings growth, up 69% in terms of revenue growth, really strong. However, the valuation is stretched. I know it's been higher, but it's a much more mature company now. It's the largest company in the world, and it has a very high valuation. Apple seems to be getting better. Apple had a decent quarter, up 12% earnings growth, up close to 10% revenue growth. The multiple of 20 or 30 times for Apple, it's high, but we think there's a little bit of a trade there. We actually bought some. I can't believe I'm saying this. We bought some Apple for a trade last week. We're not sure how far this is going to go, but the sentiment's going in the right direction. The tariffs with China are probably not going to impact Apple at this point. So Amazon to us looks like it's still interesting at roughly 31 times. Amazon has great potential for margin expansion. So they were capacity constrained in their AI business. It grew about 17%. They need more power. You can see the revenue growth at 13%. So your delivery business was much slower than the AI business. However, the earnings growth at roughly 37%. So it's not a cheap stock, but we think there's more upside to Amazon. And then you look at Google. Google doesn't get any respect. This is the Rodney Dangerfield of the group. 19 times earnings. It grew at 19 times forward earnings. It grew at 22%, and revenue growth of roughly 14. They have great technology. A lot of their technology isn't generating any sort of earnings at this point. So these earnings are understated. You look at this, it's 6.4 times revenues. Of course, they've got some Department of Justice sort of issues out there, but and maybe it's less reflected in the current stock price. When we bought it earlier this year, I mean, it's probably 30% lower. It's had a nice move, but we still think Google is the best play in the group at this point in time. Now, thinking about the group in general, what's the upside, right? You can see the chart here. It was higher versus its 200-day moving average early in the year or last year, and then we had that huge correction. It's come all the way back, and it's higher with the growth slowing down just a little bit, but it's 15% over its 200-day. If this was the S&P 500, we would be seeing a really good sell signal for this index. So it's stretched a little bit. It could get more stretched, but we think people should be cautious about these names at this point in time. Now, how to play the trend, right? So power is good. KYN is a closed-end fund with the pipes, the natural gas pipes there. I think that's a nice way of playing it. We need more natural gas. It's not sexy, but it's going to work over time, we think. And it trades at the KYN trades at a 10% discount to NAV, has roughly an 8% dividend yield. So what else could you want, right? Nice conservative position in a portfolio. Now, a little bit more aggressive is Marvell. Marvell is similar to Broadcom, AVGO. Not the valuation, it trades at 31 times. It's well off its high. So 31 times versus roughly 46 for Broadcom. And it trades at a nice discount versus Broadcom in terms of its EV to sales, and it's growing faster. So this is more of a pure play than Broadcom is. So next year we're expecting 32% earnings growth versus Broadcom currently at roughly 29. Not a big difference, but Marvell is a more of a pure play on this. Broadcom has all sorts of other businesses that, and the AI is not the dominant part of their business at this point. So how to play this? We think going down to the second tier, there's all sorts of good second tier stocks to look at. So going down to the second tier stocks, my favorite at this point is probably Marvell. Thank you. Just keep in mind what we've been doing is pulling back our equity positions, raising cash, and looking for some sort of correction, or just avoiding the risk for a while. Markets at a high level, valuations are high, we're at a seasonally tough period. We have to look out to next year, full year's earnings to get some nice upside potential for the overall stock market. So we're roughly we're roughly about 16 months into that, looking out to next year. That's a long time to wait. So if you have any questions, come to my website, Patrick Adams CFA. Also, so you can ping me there. Also, sign up for a hard copy of Mark in a Minute. My firm is called PVG Asset Management. If you're ever interested in what we do, just come to the PVG Asset Management website. You can see our strategies. So I hope you're having a great summer. Hopefully it's not too hot like it is in Denver last week. Again, if you have any questions, let us know. Take care.